Today, folks, there is nothing stopping this bullet train of a bull market. In fact, it's accelerating, and we hit a major milestone watching the top 1% now amass more wealth than the entirety of the middle class. And there's nothing that breaks my soul more than watching my accounts go up every day, making me more money than my job is, knowing that I have friends and family that aren't a part of this investor class. And the whole aspiration of this channel is to bring up people that are in their 20s to become a part of this investor class. I started investing when I was 23, and now my 33-year-old self is greatly thanking me for all that heavy lifting I did when I was much younger. And I know even if you're starting later in life, the next best time to plant a tree, guys, was today. I know you wanted to do it 20 years ago, but for the love of God, will you start today? We can't let the 1% own and amass all the wealth in this damn country. It is a frigging shame. And on my path to financial independence, to perhaps one day retire early, I'd appreciate if you join me on your financial journey by hitting that subscribe button, because we're going to talk about the asset classes that are outpacing this year. We're going to zoom in on the Canadian economy. As a Canadian, it is impressive to watch our markets outpace the United States, and I want to break down some of the sectors and why that is the case. So diving into this, first and foremost, hit that like button, because I'm not going to bullshit you here. There's nothing boring or consistent about the S&P 500. I hear so many investors say, oh, 10% a year, it's so boring, it's consistent. I'd rather focus on what all these other influencer clowns are talking about that'll likely lead you to a detrimented rate of return, not knowing that the average rate of return in the S&P is much higher than 10% and historically has a lot of years of 20% returns. In fact, if you've invested $10,000 every year for the last 15 years, the average rate of the S&P, guys, has been 14.7% a year. It's a lot higher than 10, and it well outpaces the inflation rate, guys, and it would give you over $500,000 for investing $150K. That would completely set up your retirement and bring you out of the lower kind of class and start actually giving some wealth to the middle class. I think it would be an incredible thing to do, knowing it's not hard to delay gratification. Do you need a new iPhone every damn year? No. Go buy yourself some Apple stock, guys. Start buying your time back. I don't care if you pirate content, if you're buying Netflix stock instead of buying their damn subscription, that $5 coffee every day, forget it. Make it at home. Buy Starbucks stock. And you might be thinking that's a bit boring, but what do you value in life? I mean, seriously, I value my time, guys. There's nothing more important, especially when you're knocking on death's door, to realize when you look back at life that I just worked my whole life so I could drive a nicer car and have a nicer house, but never actually have time to enjoy it or travel and experience culture and spend time with my family. That's what you sacrifice. But when you're buying investments, you're buying back your time. It is the most valued commodity on the planet, yet no one talks about it, especially on Instagram, TikTok, when you're just being fed over glorified luxuries that have no meaning at your deathbed, right? So take that into consideration as we look at the top weighted assets that have completely dispelled what people thought were going to actually happen in the economy. And take gold as an example. How is gold, which everyone thought was a dead asset, outpaced Bitcoin this year? I thought Bitcoin was the best performing asset of all time. Every year it outpaces the entire market, guys. It ain't outpacing gold this year somehow. And we're going to talk about why that is specifically, but we'll get to it in a moment. We can see Nvidia, now the largest publicly traded company in the world. Silver, the number 6 largest asset. There's Bitcoin at number 8. We'll see if it can come anywhere near close to the insane $25 trillion market cap that gold currently holds. We got Meta up here. Saudi Aramco used to be one of the largest companies in the world. It isn't publicly traded, but estimates put it at about 1.6 trillion. As we scroll down, we'll see Taiwan Semiconductors, Tesla's in here. Look at the ETFs like SPY, guys. It is becoming it's a humbling thing to see like an investment ETF that's market cap weighted like this become the 21 largest asset in the world. I hope that actually continues. We got Ethereum up here, guys. ExxonMobil. There's Palantir. I'm sure you've heard a lot about Platinum. There's a lot of cool things when you look at like the top 50 market cap companies, because you're going to see some things in here like the Chinese Construction Bank. Thought that went through like a historic crash, didn't it? But regardless, guys, I want to talk about why we're not necessarily in a bubble. Even though these assets are absolutely expanding right now, so are their fundamentals. And I think that's what the disconnect is, because the forward P on the S&P today is sitting at around a 23.7. And people are comparing this to the dot-com bubble, which I think is completely foolish, because in the dot-com bubble, we were trading at a 33 times forward multiple, guys. Now, are we in an expensive market? Sure. But for as long as earnings continue to excel beyond beyond expectations, there's no reason we can't keep moving higher or even hold higher valuations than we're currently seeing today. And what's really impressive to me at the lower value of the broader markets, the Canadian markets are actually sitting in a new territory that we haven't seen in quite some time, not only by valuation, but by growth. And if we just compare that performance to the likes of the S&P 500, it is insane to think that, the S&P is only up 13-14%. And if you include the dividend that Canada has, that is over double that of the US, guys, we're up even more than what is seen on this chart. And if we zoom in, guys, it's every sector of the market virtually, with the exception of a handful of companies. Finance, we're going to talk about the Canadian banks, why they're crushing it. Non-energy minerals, precious metals. Let's talk about this first and foremost because, whew, baby, I don't know what is happening here, and only the likes of Gemini are going to help us kind of uncover this like Sherlock Holmes, because gold and silver, why? Why are they in this kind of perpetual up into the right market, and is it unsustainable? Again, I keep comparing it to crypto because I hate the crypto bros that have been preaching that Bitcoin is the only asset that's going to replace gold and all these things as reserve currencies, yet we're seeing major countries turn to gold and precious metals over crypto. So the weakening US dollar helps a lot. I didn't realize that around the world, like oil was, gold is traded pretty much purely in USD. So now that the US dollar is dropping a lot, it is allowing foreign countries, governments, individuals to buy gold at actually a cheaper rate in their given currency, which I found really interesting. Central banks, with the kind of conflicts of the US and the deteriorating US dollar, to bolster their reserves globally, guys, they're buying gold. China, India, Poland, Turkey. These people are looking to build up their bank reserves, and they're not using crypto or anything else. They're just turning to precious metals. Persistent inflation, economic uncertainty, again, geopolitical tensions and investor demand. It's insane watching like both institutional and retail investors apparently increasing their exposure to gold. This is evident in the significant inflows into gold-backed ETFs. Really interesting stuff. So in conclusion here, is it sustainable? While the short-term price fluctuations are always possible, the current gold rally appears to be supported by a convergence of powerful long-term drivers. This suggests that the bull market for gold could be more than a fleeting phenomenon and has the potential to be sustainable for the foreseeable future. It's incredible that Gemini is giving this kind of investment advice. Shifting to the banks, though, this is also a very intriguing aspect of the market that I've talked about precipitously because people are calling this overpriced, too expensive, and I'm here to tell you the fundamentals say otherwise. I mean, if you look at the BMO Equal Weight Bank ETF to get a 25% return in 1 year, whew, that is wild for mega cap banks that are now trading at returns the like of tech companies. And we've seen the yield deteriorate. And I know this really hurts income investors, but I'm a total return investor, guys. And I know it's really hard to invest in the Canadian economy when dividend yields are shrinking to virtually nothing. But if you just look at the fact that the markets are going up the way they're going up and the projected returns, I'd still be very comfortable cost averaging here. And the reason that this is happening is the same thing that I told you guys. And luckily we'll see Gemini backs up my thesis here, but we're seeing an earnings explosion, like an EPS explosion in many of these banks that was basically a delayed reaction because of interest rates. I mean, with the exception of one bank, Royal Bank is blowing up, seeing double-digit returns up to 20% EPS growth. I mean, Canadian Imperial seeing high double-digit in the teens of earnings growth. I mean, you look at BMO here coming back at 26% earnings growth. So when we look it up, and I can't get over how good that Gemini really is at breaking down like financials and why stocks are doing so well. It's really incredible. Like it has a more structured thought than most people I listen to on like BNN or Fox or whatever like stupid business network you listen to. But basically, the Bank of Canada cuts rate. The Bank of Canada resumed cutting its key interest rates. This is easing of monetary policies. Policy is a proactive measure to support the economy and is generally viewed as a positive for the financial sector because lower interest rates can stimulate economic activity, leading to more increased loans and demand with strength, basically stronger than expected earnings. What's really neat to me is the higher revenue we've discussed on the back of no immigration growth, all this economic tariff war and uncertainty. We still are hitting record revenues for the banks, but lower provisions for credit losses, which I preach a lot on this channel. We're finally seeing the extinguishing of loan losses or loan loss provisions. This is a significant factor. Banks set aside money in provisions for credit losses to cover potential loan defaults. Not that the loans are defaulting, just for the potential of. A notable decrease in these provisions suggests that the banks are more optimistic about the credit health of their consumers and overall economy. This signals that they are not anticipating a large wave of defaults, which is a major concern for banking sector during economic downturns, guys. So while the outlook is cautiously optimistic, it is important to remember that some risks remain, including ongoing trade policy uncertainty and potential volatility visibility around future economic data releases, and we know that's the case with jobs and everything else. But regardless, guys, we lose jobs here, we pick it up somewhere else. I mean, the sector is kind of an ebb and flow nature, and right now, let's be real, if you're losing jobs in steel, they could be made up for in mining. Who really knows, right? But regardless, the only other aspect of the Canadian economy that is really important, that I find really interesting, especially considering we don't look at it from the long-term perspective anymore and we're really focused on the short term, that is oil. Oil prices have come down quite insanely. Like, we've seen oil kind of come down quite nicely over the last 5 years. This is making it a lot easier on our gas tanks. But the reality is oil usage is still way up, guys. And we're seeing like some of the major oil companies like Suncor up 12% this year before the crazy dividend that it pays. Enbridge is up 23%. Again, expanding in the natural gas. Canadian Natural Resources is lagging a little bit. If you include the dividend, it is actually green this year, but the reality is usage is going up. Oil demand is hitting all-time highs. And I know if you want to talk about the carbon-free future, guys, which is something I still think is relevant, even if you don't believe in global warming, you have to understand the easy reserves, like the easy oil that exists out there, guys, is depleting dramatically. And everybody knows over the next 50 years, we do need to start converting to other energy sources. So as much as people are like pumping up that they love oil like Trump does, you have to recognize that this is going to be a fairly short-lived commodity as a use case in the next 100 to 200 years. Because again, this is the easy reserves. This is just what we know are major reserves that are easily accessible without new technology, new discoveries. Again, oil is going to become a fascinating conversation when I reach the age of retirement, guys. So, oil, I think, is going to be one of the coolest sectors to watch evolve over my lifetime, just to see how it shifts and what we end up using as alternatives. But regardless of how you feel about global warming, the reality is we only have so much of it, guys. Very interesting conversation nonetheless. But as I kind of wrote back around to my portfolio, like I said, I'm sitting here every day watching the accounts hit new all-time highs, perplexed by it all, but not stopping my cost average journey, because again, guys, the market could run another 20% before correcting 20%. That's just the reality of it. So don't try and predict the future. We can't, but I will pass the question off to you. I'd love to know what you think about this ever expanding bull market and how you're taking advantage of it in that comment section below.